Hello, this is Dr. Shashi Srivastava from the Institute of Management Studies, Banaras Hindu University. Friends, here we are there to discuss the course Essentials of Financial Management, where I am dealing with the 4 important units, and we have started with the sources of finance, where we have covered already the overview providing the different sources of funds. Then we have also shifted to equity shares and also the preference share. Today, we shall start the discussion on the debentures, bonds and the term loan. So, let me start with the concept of debenture. Debenture is a instrument whereby a company promises to pay to its debenture holders a periodic payment in the form of principal and as well as the interest amount. And when the company issues the debentures, the holder of the debenture, they are not the owners of the company, rather they are the creators of the company. What do we mean by saying the creators? Creators means they are not as a stakeholder in a company just like the ownership, because here they would not bear the loss of the company, rather they would be getting the periodic payment of principal as well as the interest whenever it is due. And even when there is no profit, company is under obligation to pay the interest and the principal to the debenture holder. So, this is the concept of debenture, and this debenture is issued under a common written agreement whereby the company would mention that the specific amount of money as is stated in the agreement would be paid in a fixed date in future, together with the periodic payment of interest to compensate the holder for the use of the fund. And now let me tell you what are the terms and conditions included in the common agreement, which is the important feature of the debenture. So, this trust deed would include the protective provisions that would usually include the limits on the indebtedness, the restrictions on the dividends, provision of sinking fund, when the debt would be redeemed by the company and whether it is convertible in the equity share or not, and what is the minimum current ratio that is to be required in the company. And then with this common agreement, the debenture holder would serve as a creditor of the company. And for the example, there are unsecured bonds issued by the company to raise the debt capital as and when it is required by the company. As against the debentures which is issued by the private company, the bonds are a broad category of debt instruments where it is issued by the government, corporations or the entities for raising the capital, and this bond are normally secured against the fixed assets which is available in the company and they are kept as the collateral. For example, there are treasury bonds, corporate bonds and the municipal bonds. Now, it is important to discuss what is the difference between the bonds and the debentures. So, in some context, the bonds and the debentures are used interchangeably, particularly when it is referring to unsecured debt instrument. So, here for the understanding purpose, we can discuss the difference between the bonds and debentures under different heads. The number one is the definition. The bonds are issued by government, whereas the debentures are issued by the private company. The second head under which we can discuss the difference between the two securities are the securities. The bonds are secured by the collateral, while the debentures may or may not be secured or it may be unsecured. That means they are not backed by any collateral or a lien on any specific assets. Now, the third point of differentiation between these two instruments are the risk. As it is clear the bonds are secured and debentures may or may not be secured, the debentures they are unsecured and generally considered riskier than the bonds, because investors in debenture they mostly rely on the credit worthiness or the reputation of the company. Now, see the return of these two instruments. The bonds, because they are secured, they carry lower risk than debentures, but the bonds they are actually having no risk, but the returns are also lower, as we can see that the repayment during the liquidation is also done to the bondholders before the debenture holders are paid. And as far as convertibility are concerned, bonds cannot be converted into equity share, whereas these provisions are available with the debenture holder. So these are the points of differentiation. We can see by definition they are different. The security, the risk, return, convertibility, as well as the repayment provisions are different from bonds in case of debentures. Now we shall discuss the features of debentures. So as we have seen that any instrument, any securities can be best described under four heads. Number one is the maturity, then claim on income, claim on assets, and finally the controlling power. So let me use the same format for discussing the characteristics of the debentures. So let's take the first point as maturity. Unlike stocks which has no maturity date, a bond matures, a debenture matures, and the principal amount of bond must be repaid at a definite time stipulated in the bond indenture. Otherwise, creditors may bring foreclosure upon the company. That means if the interest is not paid, or at the time of maturity, if the capital is not given back to the debenture holders, now the debenture holder has got full right to take this company into court for realizing their dues. The second feature that can be used to discuss the characteristics of debenture is a claim on income. The bondholders have the first priority for the claim to income over the stockholders. That means before shareholders are paid dividend, the interest has to be paid to the debenture holder, and they have the legal recourse for enforcing their right. The claim on income. The claim on income is followed by the claim on assets. This claim arises in the process of liquidation, and it is very much clear that the bondholders have again priority over stockholders in respect of their claim on asset. That means when the liquidation or company is getting winded up, now the first and foremost priority is given to the debenture holders. Then only equity shareholders are given any amount of capital that they have invested in the company. But the last point, that's the controlling power, compensate for all the previous features of the bondholders. That means since they don't bear any risk of the company, they are the creditors of the company, they do not enjoy any controlling power because they don't have any right to vote for the election of directors or further determination of important managerial decisions. So these are the features of debentures. This can be very helpful in also discussing the classification of the debentures. Let's see what should be the different form of debentures. So first feature is maturity. Based on the maturity, the debenture can be classified under the convertible debenture, non-convertible debenture. Let me tell you what is convertible, what is non-convertible. So at the end of maturity period, if the debenture holders have signed an agreement where it is written clearly that at the time of maturity debentures would be converted into equity share. So these kind of debentures are called the convertible debentures, and when there is no such provision is likely to be applicable, then they are called the non-convertible debentures. There are another classification based on whether they can be redeemed before the maturity period or not. So on that basis, it could be callable or non-callable debentures. Here, if the debentures are repaid even prior to maturity period just by allowing 1 or 2% of call premium, it is called the callable debentures. And when there is no such provisions applicable, they are called the non-callable debentures. Now the third category is called the redeemable or the non-redeemable debenture. So redeemable debenture must be paid, as the name suggests, after a specified period, either in a lump sum or in installment, whereas irredeemable debentures, also known as perpetual debentures, these are not intended to be repaid during the company's lifetime, and they are paid only when the company is getting liquidated. So this was the classification of debentures on the basis of maturity period. Second classification is based on the claim on income, and based on this particular feature, the debenture can be categorized as income bond, income bond where they have got some right to participate in the additional income of the company. As we know that the interest on debenture is fixed. So here there is no as such question to participate in the surplus income generated by the company. But if it is an income bond, then naturally this right is given to the bondholders to claim on the additional income of the company. Now, whether they can claim on the previous year's income or not, previous year's interest should be paid to them or not, on that basis they can be categorized as cumulative or non-cumulative. And here non-cumulative or cumulative differentiation is being made only on the basis of the fact whether they can claim on the income of the previous year or not. So, if it is cumulative, of course, they have got right to participate or to claim on the previous year's income, but if it is non-cumulative, they should be satisfied with this year's interest only. Now, based on the coupon rate, we can have the two categories of debentures. Number one, the coupon rate debenture. Coupon rate is the other name of the interest rate. So, when company has agreed upon to pay a fixed rate of interest, it is called the specific coupon rate debentures. But there are zero coupon rate debentures where they do not pay any periodic interest, but they are sold at discount to their face value with the difference treated as interest paid upon the redemption. Like initially the investor would pay a very small token, say 5,000 or 10,000, but at the time of maturity they can be given say 25,000 or the 30,000. So, the difference between the value at the time of maturity and the face value is treated as the interest to the debenture holder. Now, the claim on assets or security is another basis to classify the debentures. Here we can have the secured debentures as well as the unsecured debentures. So, unsecured debenture which is not backed by the asset, but unlike this, the secured debentures are backed by the company's assets or property as collateral. And now here they can be like mortgage debentures, collateral trust and the equipment trust debenture. Mortgage means where the property of the company has been kept as the collateral or as the security. Close end and open end clause, they specify whether the company can raise additional fund on the same asset or not. So, if it is closed end, the one asset can be used only for one time, but if it is an open end clause which has been prevailing while issuing the debentures, then the same assets can be used for raising the additional debentures. The collateral trust debentures is one where the securities of the company, the financial securities can be kept as the collateral, whereas the equipment trust debentures are where the equipments of the company can be kept as the security of the company. Now, it's a time to see what are the advantages and disadvantages of the debentures to the company as well as to the investors. As if the features are clear, it is very obvious that the debenture holder, they enjoy comparatively lower rate of interest because they bear lesser risk. So, the rate of return is also low. Trading on equity, it is a very important concept under the financial leverage, where any institution will furnish debt capital only when the company has the equity capital. So, trading on equity is possible. That means company can take the benefit of leverage by raising debt capital, which is comparatively cheaper instrument as compared to equity. Then company can lower down WAC, so that is weighted average cost of capital, and thereby it can increase the return for the shareholder as well as the value of the company. Then third benefit is associated with the debenture or the tax benefit. We have already discussed in some discussion where the interest on debenture is a tax deductible item. That means when the company is going to calculate the tax liability, it has to first deduct the interest from the EBIT, that is earning before interest and taxes. Then only the tax liabilities are calculated. So, it would reduce automatically the tax liability of the company. Certainty of finance, especially in the case when the economy condition is not good, investors do not have the surplus money to invest in the equity capital, still company can be assured of getting the finance in the form of debentures. And so during the recession period, it is acting like a boon when there is no other fund available for the company, but no share in control. It is the very important disadvantage for the shareholder, but the company is enjoying this feature as it do not have to share the controlling power or the decision making power with the shareholder. Flexible capitalizations, one term which is used for the fact that the debentures have the maturity period, and after the expiry of the maturity period, the amount of debenture capital can be paid back to the shareholders. So by that amount, the company's capitalization will be lower down. For the investors, it is providing the fixed and the stable income, safe investment, and it is less riskier as compared to equity. There are liquidity as can be marketability is there, and the loan can be converted into equity shares. So thereby the holders have got the some kind of possibility to be the owner of the company, and it is not taxable even in the hands of the investors. So at least these are the benefits, but yes, there are certain disadvantages to the company and to the investor as well. The first, the compulsion comes in the form of fixed burden of the interest and the principal amount. So company, whether it is having profit or not, it has to pay periodically the interest and the principal amount. Then company would also have to keep some of the asset as collateral. So there will be a fixed charge on asset. In the course of distress, the creditors can have their say, and they can also sell the asset to the company to realize the dues, and as a result there are chances of bankruptcy. What are the disadvantages to the investors? Let's see. They cannot participate in the extra profit of the company unless until it is income born. No share in the control, no interference in the decision making process, and sometimes if the condition of the economy is not good, they may suffer from the problem of not getting the interest and the principal for some time. So the question arises, what should be the priority of the company, whether to go for debentures or go for equity share. So let's see what is the condition that favors the debenture as a mean of finance. One, when the income of the company and the sales are relatively stable. Now, why this? Because unless until the earning and the sales of the companies are stable, they cannot pay the interest to the debenture holders. Then when the debt equity ratio is low, that means if the company is already having more than 2:1 debt equity ratio, that is the standard one, the further debt is not possible to be raised by the company. Even the institution will not be ready to provide loan to this company where the debt equity ratio is very high. When management wants to retain control, yes, this is the best security to be relied upon when company is least interested in sharing its control, and when the fixed assets are less in the company, then it shouldn't go for debenture, rather it should go for the equity. So with this we have come to an end with the debenture as a source of finance, its features, the classifications, its advantage and disadvantage, particularly to the company and to the investor as well. So associated with this creditorship security, we have got another instrument which is known as the term loan. What is term loan? As the name suggests, the term loan is a loan where the company can get it from the institutions directly or from any bank. In India, they are generally obtained for financing large expansions, modernization projects or diversification projects. Therefore, the method of financing is also called the project financing. And as the nature suggests, It represents the long-term indebtedness of the company, the maturity ranging from more than 1 year to 7 years, and where it is obtained from banks and especially created financial institutions in India. Now, if we have to see the characteristics of the term loan, we can see under different heads, like what is the purpose of term loan, what is the maturity period, what are the repayment schedule, whether the company enjoy any flexibility or not, whether the securities are offered to the institutions or not, and what are the cost. And finally, if it is to be given to any company or any organization, what are the measures for protecting the interest of the institution. So, let us see the purpose for which the term loan is given. They can be economic purposes as well as the financial. Economic purpose includes the expansion, the research and development, and sometimes for in correcting imbalances in the current assets, the term loan is also taken by the company. And financial purpose includes the tax advantage, because the interest on debenture, interest on the term loan, just like the interest on debenture, is a tax deductible item. So, it will lower down the tax liability of the company, and of course, the retention of control is possible when the term loan has been taken as a source of finance for the company. Maturity ranges from 1 year to 7 years. Repayment schedule can be tailor-made and it could be negotiated between the lending institution and also between the company. It can be an installment payment, or there can be some lump sum payment towards the end of first year, second year, third year, or and so on. As far as flexibility is concerned, the term loan is very flexible as far as the payment of interest and security is concerned. And security of this term loan may involve some of the property, some of the equipments, and the financial instrument of the company. The cost of the term loan include the interest, that is the explicit cost, some negotiation cost that includes the cost or the fees offered to the attorney of the company, and this term loan also has some opportunity cost or the implicit cost, where the lending institution may ask the company to maintain a certain reserve. So, interest sacrificed on that reserve can be termed as the implicit cost, which of course is the part of the cost associated with the term loan. Now, there are very important feature associated with the term loan, where the lending institutions, they put some covenants, they are called the protective covenants on the company. There can be some positive covenants which actually do not interfere in the day-to-day functioning of the company. Like if the company is asked to provide the financial statement, quarterly financial statement, half yearly, so there is no as such problem to the company. So, this is a positive covenant. Sometimes the company may be asked to allow the inspection by the lending institutions, and they can also be asked to pay the premium, insurance premium, and the maintenance charges as and when they are required on the equipment. But there are certain negative covenants, like lending institution can restrict a company from paying dividend to shareholder. Actually, all these covenants are there to protect the liquidity position of the company. So, they can also say you should not enter into leasing arrangement, because again it would involve the cash outflow. Then additional debt cannot be taken. Such kind of provisions can be, such kind of restrictions can be made by the bank. Then they can also have a ceiling on the managerial compensation. No, you cannot go beyond this. And merger and acquisition activities can also be restricted if a company has taken term loan from the bank or the institutions. Let us see whether the term loan offers any advantage or benefits to the company or not. One is the structured payment, where the fixed payment has to be made to the institutions. So, it is easy for the company to schedule the repayment. Then access to larger capital is sometime when the other sources of finance are not available, it is possible to get funding in the form of term loan. Lower interest rate as compared to equity capital. Flexibility in uses, funds can be used for various purposes. Then there are certain tax benefits available on the term loan, and preservation of ownership or retention of control is another benefit available with the term loan. Now, what advantages investors are going to get? No, they are going to get fixed return from the company, lower risk as their interest is protected by the security in the form of fixed assets. They also enjoy priority over the stockholders in terms of repayment. Tax efficiency is there because the income in their hand is not taxable, and a stable investment opportunity is another benefit associated with the term loan. Now, there are certain drawbacks of this security. First is the fixed assets are kept as security, so there are collateral requirement. A strict payment schedule adhering to which is compulsion for any company. There are costs associated with term loan, the interest cost, the legal cost, some opportunity cost. And the banks actually follow a very rigorous process for approving the term loan. Then limited flexibility and potential for further debt. It is also not possible in case company is already overburdened with the term loan and some other creditors of securities. There are certain disadvantages to the investors as well. If the bank defaults, again they may not get their interest, and they do not participate in the additional income of the company, so the return is fixed. Then their interest is also being backed by the collateral or the quality of asset that is being offered as the security. If the asset has got its good market value at the time of liquidation, they would get their dues. Otherwise, there is a possibility that they may have to suffer a loss, and they don't have any say in the controlling mechanism of the company. So, whether it is suitable for the company, for the investors, yes, when the larger scale projects are to be funded, this is a good source of fund. Then financial planning can become predictable because the company would be having a consistent preset repayment schedule, which allows them to precisely budget for all their expenditure and the income. Cost of borrowing, they are of course lower as compared to equity. Their long-term growth, which can be supported with this type of funding, and a stronger credit profile can be developed if the company has made regular and periodic payment to all its lending institutions or the bank. So, with this we have completed the two very important creditors of securities. I hope you have enjoyed and you've understood all the important concepts associated with the term loan as well as the debentures, including what is the maturity period, whether they have a priority and certainty of claim on income, whether they have got any right to sell the asset of the company in case company is not consistently paying the interest and the principal amount, and yes, do they have any right in controlling the decision making of the company or not. So, with this we come to the end of this another source of fund, debentures, bonds and the term loan. Thank you very much.